How's it going, guys? My name is Nick, and if you're new to my channel, welcome to Investing Engineered. So over the past few months, I've been hearing a lot of talk about the next recession coming. For example, I've been hearing people saying things like, the recession is significantly overdue. Protect your assets by investing in gold now. Unemployment is at an all-time low. The yield curve is inverted, so the next recession must be coming. All jokes aside, the next recession is something that we should start thinking about. Now, despite all of these indicators and predictions for the next recession, the truth is, no one truly knows when the next recession is going to happen. However, the one thing that we do know is whether it be in the near future or in the far future, a recession will happen and it is inevitable. But I'm about to share with you why you should not fear the next recession whatsoever. In fact, you should actually embrace it with open arms. And after watching this video, you'll begin to understand how to survive the next recession, but also how to thrive like an intelligent investor would and actually make money during this period of doom. So if you do enjoy the video, be sure to smash the like button, and if you haven't already, consider subscribing for more content on personal finance, business, and investing. And with that said, let's talk about the 3 tips that will help you make it big in a recession. Alright guys, so the first thing that you do need to realize is simply that fortunes are born in recessions. For most rich people, recessions are actually the starting point to building wealth and actually creating a better financial future. There's absolutely no question about it, but it all depends on how you play it out. Typically what you hear from people is that by selling your stocks and equities in the early part of a recession, this is the best way to save your portfolio from future losses. And then when the market starts turning around, you can start buying back in at a lower price. But this is actually a terrible strategy, and allow me to explain why. For one, if you think you can time the market consistently, meaning that you buy right at the bottom and sell right at the top all the time, you would be the richest person on the planet without a word of a lie. I personally think it's fair to say that timing the market is actually impossible, even for the expert investor who spent years studying stock market fluctuations. So then the next best strategy in a recession, and the one that I personally implement into my own life, is to simply keep buying shares of wonderful businesses as the prices keep dropping. Think of it as your favorite pair of Yeezys that are actually going on sale on Black Friday, and you cannot resist buying as many as you can. Obviously, nothing about the product itself changed, but the price just got cheaper. Well, basically the exact same thing can be said about a company. In a recession, the whole market drops, bringing amazing businesses down with it that don't deserve to drop in stock price. This ends up becoming a huge fire sale for investors to continue buying these shares at a discounted price of these wonderful businesses. All the while, the fundamental value of these businesses remains intact and unchanged. Through buying these shares at a really low price as seen in a recession, this will actually have an amazing impact on your portfolio in the long term. For example, if you bought Apple stock in 2018 before the big crash in December at about $175 per share, and you waited through the ups and downs until where it's at today at about $200 per share, you would have made a return of approximately 14%. On the other hand, if you initially bought some shares at $175 and then noticed that the stock was crashing even though its business value remained intact, you would keep buying these shares at discounted prices, averaging down to about $150 per share. And then if you were to sell them today at $200, your return would be 33%, which is over double the return that you would have received by not buying the dip. So obviously, by lowering your cost basis by purchasing shares at a cheaper price in a recession, when you come out of that recession, your share prices are going to appreciate and your returns are going to skyrocket. Unfortunately, the majority of people will actually avoid investing altogether because of these unavoidable recessions. But as intelligent investors, we can take advantage of these recessions and have them benefit us in the long term. Now, if you're heavily invested going into a recession, the one thing that can save you is a war chest of cash. Cash is the one redeemer during a recession because its value does not change, outside of inflation, of course. So the best strategy going into a recession would actually be to hold some cash on the side in a high interest online savings account. First of all, your money's going to be protected from inflation because you're earning an interest rate of about 2 to 3% in the online savings account. And secondly, whenever you're ready to pull the trigger on buying some amazing businesses at a discounted price, your money is going to be available to you. Now, some of you may be wondering, well, Nick, why didn't you recommend putting your money into a GIC or a CD that actually offers a higher interest rate than a savings account? Well, I really don't recommend this because your money ends up being locked up for a certain period of time, and you might not be able to use it when you need it most. An example of someone who's actually taking advantage of this strategy is actually one of the greatest investors of all time, Warren Buffett himself. Currently, Warren Buffett is holding over $100 billion worth of cash in his investment company, Berkshire Hathaway. Warren Buffett has learned from his previous experiences in investing, and now he has a war chest of cash ready to deploy within any recession that's coming ahead. This would actually allow him to make an acquisition of a company up to $100 billion, or he could just buy shares of companies at a discounted price. So overall, it's a really smart idea to just save some money on the side for a rainy day in the market, and it will definitely allow you to create more money in the future. Alright guys, so all of these tips and everything that I said beforehand will only matter if you can actually control your emotions during a recession. We all know that stock and equity prices drop dramatically in a recession period, and that is something that we cannot control. And if you are an owner of equities going into a recession, it's going to be very tough seeing your portfolio value decrease every single day. But the one thing that you can control as an investor is your emotions and the way that you react to market fluctuations. As an intelligent investor, it's very important to be able to manage your emotions and be in control by not making stupid decisions. For example, a stupid decision would actually be selling a stock just because the price dropped, and that is usually guided by fear. So before selling the shares of the companies that you own, you really need to make sure that you understand if the underlying value of the business has changed at all, and not base your decisions on your emotions. For example, if a company reports poor earnings and projects slower future growth, that might be an indication that the underlying value of the business changed and decreased a little bit, so it might warrant a sell. However, if a company is caught in a news scandal like Facebook was with Cambridge Analytica in early 2018, this is generally an indication that the company's value has not changed intrinsically, even though the price has dropped. In this scenario, it was actually a great idea to buy more Facebook stock at the discounted price because the stock actually recovered in about a year's time. One of the cardinal rules of investing is to not lose money, and that means to not sell a stock at a loss unless it's absolutely necessary. So when you do feel this fear in a recession, just analyze the situation, and if you think that company is going to be fine in just a few years' time, then buy more shares at a discount. It's probably going to be a rare opportunity. And you should do this with your own confidence, even if people are screaming at you and telling you not to buy. As Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. Anyways, thank you guys so much for watching the video. If you did enjoy or gain value from this video whatsoever, just smash the like button for me. It really helps out my channel. And if you haven't already, definitely consider subscribing for more content on personal finance, investing, and business. Until next time!